today, the slide continues. Hello again, it's Martin North from Digital Finance Analytics. Welcome to the latest post covering finance and property news with a distinctively Australian flavour. And today we're going to look at the latest data from the Australian Bureau of Statistics relating to lending, which is down, and also touch on the NAB's Business Confidence Survey, which came out today and which is down. And finally, a brief mention of the latest paper from the Reserve Bank, which is trying to explain why home prices are falling without making any association with credit and credit availability, which I find frankly remarkable. And if you would like to support our work, please consider making a one-off donation via PayPal, here's the link, or subscribe via Patreon, because that allows you to support us each month. And we really appreciate those who are helping to support us make great content. The links are also in the comments below. So firstly, let's look at the latest data from the Australian Bureau of Statistics. They released their latest data today, which is the new format covering all of the credit flows across housing, personal finance and business in one release. And frankly, I'm still getting my head around some of this new data, but there are some very important messages contained within there. Now, quite a good place to start is with their media release, where they say that lending to households fell 2.4% in January 2019. That's seasonally adjusted according to their latest figures. And that follows a revised monthly fall of 3.6% in December. And the chief economist says weaker lending for dwellings, down 2.1%, again drove much of the overall fall in lending to households, with further falls in lending for investment dwellings, down 4.1%, and for owner-occupied dwellings, down 1.3% in January. Reflecting the impact of both supply and demand factors, new lending for dwellings is down over 20% from January 2018. And the largest through-the-year decline seen since 2008. And the weaker lending activity was evident across the states and territories in January, with new lending for investment dwellings down in all states and territories. Only Queensland and Northern Territory recorded rises in lending for owner-occupied dwellings. And while there was also a fall in the number of loans to owner-occupied first-time buyers, down 0.3% in January, this was more stable than the 3.2% fall in the number of loans to owner-occupied non-first-time buyers. And they also covered lending for personal finance, which was up 1.2%, which actually was the only household lending category to record a rise in January. However, new lending is down 16% compared with January 2018, seasonally adjusted. And the value of lending to households for refinancing fell 3.4%, and in trend terms, the value of new lending commitments to businesses fell 1.3% in January, but is up 2.5% from January 2018. So now let's look at the data in some more detail. I'm going to focus on the trend data because I think it probably provides a better picture. So this chart is showing you the lending flows in trend terms to January 2019. And the first point there, if you look across all categories, the flow of new loans is down, and actually quite a lot down from, let's say, August 2018. In fact, there is really very little evidence of any trend movement up at all. And now this is the annualized flows for all types of lending from 2014. And look how the yellow line, which is investment lending, dips and then rises. Owner-occupied, the blue line, also is accelerating away, whilst business lending has taken a slight rise recently, but more recently still, all lending flows are lower. And in fact, if you look at the latest statistics over the last 12 months, owner-occupied loans have dropped in flow terms by 14.2%, and investment loans are 24.8% down. Now, of course, you can argue that January is a funny month because it's the holiday season and quite often we get some slightly peculiar data around there. But if you look over the last few Januaries, this looks like an outlier. And my own view is that we're going to see more weakness in the lending market ahead. Now, we can also start looking at this across the states. And this is looking, for example, at New South Wales, the solid yellow line, and also Victoria, which is the dotted grey line. And it's interesting to see how we had a significant run-up in those states, as well as Queensland, actually. But now things are falling away. And in fact, other than in Tasmania, where there is a little bit of movement up, all flows are negative. And in Victoria, owner-occupied lending has fallen 15.1% over the last year. And owner-occupied, excluding refinance in New South Wales, is down 17.1%. Now, this series is important because I've stripped out the movement of existing loans from one lender to another lender. So this is looking at new finance. And this shows you that the credit impulse is certainly weakening, and quite quickly. So if we look at the first-time buyer data, this is for owner-occupier first-time buyer data in original terms, and you can see that 17.9% of loans written in the month were for first-time buyers. But the count is down, it's below 8,000 this month, down 1,200 from last month. That suggests to me that the spike that we saw when the new first-time buyer incentives were brought in is now easing away. And in fact, first-time buyers that I survey suggest that they will wait, preferring to see what happens to home prices down the road. Now, we can also look at first-time buyers, and in our modelling, we take account of the ABS data, which relates to owner-occupied first-time buyers, and we also track first-time buyer investors in the DFA surveys. Now, that orange line was quite important up until, let's say, the end of 2016-17, but is now dipping away as the incentive for first-time buyers to go into the investments market withers away. But we're also seeing a little bit of a decline in overall first-time buyer activity. And in fact, this month, the volume of first-time buyer loans was down. Now let's look at the investment trend flows by state. And it's worth watching the solid yellow line, which is New South Wales, and the dotted grey line, which is Victoria. You can see the massive swing up in 2016 and 17, and then the interesting dive down. In fact, of course, we had two sets of incentive dampeners. And so you can see there that investment lending, excluding for refinance in Victoria, is down 34%. And investment lending, excluding refinance for New South Wales, is down 34.4%. And in fact, in this chart, you can see the impact of the two rounds of APRA tightening. The first one, which was the speed limit, and the second one in 2018, which related specifically to interest-only loans. No surprise then that overall lending to the investment sector is withering further. Now let's look at the number of owner-occupied commitments by state. This is the New South Wales data. And you can see there the run-up in construction, that's the yellow line, and also the purchase of new properties, which really reached a peak in the end of 2017 into 2018, which is now consistently lower. And in fact, across the board, whether you're looking at the purchase of established properties or the refinance of existing properties, all of those are actually in negative territory in New South Wales. And that's important, of course, because New South Wales is by far the largest housing market in Australia. We can look at the same data for Victoria, and again we see a run-up in the construction of new properties and also the purchase of new properties, and reaching a peak in 2017, the beginning of 2018. But now it's falling away quite consistently and is much lower than earlier on in 2018. And what is very fascinating to me is the significant fall in the purchase of new properties in Victoria. There is still a massive amount of construction going on, and yet this would suggest to me that many of those new properties are yet to be purchased. Now looking at Queensland, again looking at the owner-occupied commitments by state on an annualised basis. And again we see quite a run-up through 2017, both purchase of new properties and the construction. But now more recently we see those volumes falling. And in fact in January there was a fall in all categories, including refinance and the purchase of established dwellings. So that shows us that in Queensland, in Victoria and in New South Wales, momentum has eased considerably. And bearing in mind that that accounts for perhaps 70% of all transactions in Australia, it's no surprise that overall home prices are falling. Now turning to Western Australia, again looking at owner-occupied commitments annualised, there was a bit of a spike earlier on. Then of course we had a number of months when momentum was easing. But more recently we've started to see just a sign of life in Western Australia, with a small rise in the number of new purchases of property. But the other dimensions there, refinancing, purchase of established properties and the construction of new properties, are in negative territory. So whilst there is a slight uptick here, setting it in context of the trends from 2015, this is still relatively slow. South Australia shows a rather different trend insofar that there has been less of a slowdown more recently. The volumes are, of course, lower simply because of the number of transactions in the state, but the purchase of new properties is still above zero, as is the established property purchases and refinances, and even the construction of new property. So the smaller states, South Australia and indeed Tasmania, are showing a little bit more in the way of life. And finally we turn to Tasmania, where of course there has been a significant build-up in momentum in the last couple of years, and that's partly because people have moved away from buying in Sydney and Melbourne and the other centres, and are thinking that Tasmania is a rather interesting place to buy. So we can see that there's been a run-up in the purchase of new properties, very considerable run-up in the recent times. But it's also worth noting that the refinancing of existing properties and the construction of new properties is now easing. And it's my own view that Tasmania will catch the cold that is affecting most other states going forward. So I expect to see momentum easing here ahead. So to conclude our analysis, it's clear to me that the January data is pretty low. And it was pretty much in line with my expectations based on what I saw from my household surveys. Now, I expect there to be a slight uptick in February and March, partly because a few more people are considering buying before the election, thinking perhaps that the negative gearing changes that Labour may bring in if they get elected will have an impact. And we've also, of course, got some extra incentives for some first-time buyers, particularly in the Northern Territories now. And there's just a little evidence coming through of a little loosening of some lending standards at the margin. Now, my own view is this is not going to be sufficient to turn the ship around, but it may mean that the rate of decline in terms of financing will actually slow in the next 2 to 3 months. And it seems to me that we will know in 3 or 4 months' time whether in fact this is the continuation of the big down cycle that I'm expecting, or whether we will see a slight recovery first before property prices fall away again. Now, I just want to move on briefly to the NAB Monthly Business Survey, which came out today, covering February 2019. And essentially what this says is that both business conditions and confidence levels fall, and now both are below the average. The decline in conditions was relatively broad-based in the month, they say, and continues a relatively sharp decline over the previous 6 months. The decline in confidence was more modest, but the series has now been below average for some time, and forward orders fell to below average levels in the month, and capacity utilisation declined further, suggesting that conditions are unlikely to regain much ground. So the chart here shows quite clearly the fall in business confidence and the fall in business conditions. Now, the other interesting dimension to their research is that we can see that retail is recording a very considerable decline, as perhaps you would expect, and construction is still in positive territory just. And the other dimension to look at is the states, where in fact Tasmania is booming relative to the other states. But across the rest of Australia, then New South Wales is roughly average, Victoria is slightly above the average, and Queensland and Western Australia is below the average in terms of business conditions. And in terms of business confidence, New South Wales is recording the lowest level. And I think that is very concerning because, of course, New South Wales is one of the biggest states, a lot of momentum, but it's consistent with the report that I made yesterday when I highlighted the fact that the construction sector and retail sector are actually concerned about future prospects. Now, my takeout from this chart is it is quite possible that we're going to see unemployment start to rise. And if it did, that would certainly take the wind out of the sails of the RBA, who of course has been saying for some time that unemployment will continue to fall. And my point is this: if unemployment does actually start to pick up, then that will have a significant direct impact on housing, on mortgages and mortgage stress, as well as a broader impact on the economy. Now, the final thing I want to talk about today is a piece of research that was published yesterday by the Reserve Bank, and it was entitled A Model of the Australian Housing Market. Now, when I saw this headline, I thought, perhaps finally we'll get some real insights from the RBA on what they're thinking about the housing sector. So I downloaded the research paper and, well, frankly, I was rather disappointed. In a nutshell, the reason why I was disappointed was because their model, which includes things like interest rates, building approvals, housing stock, numbers of dwellings, rental vacancy rates, rents, dwelling prices coming out the bottom, and of course impacted by income, population, unemployment rate, misses something rather obvious, and that is credit. I don't understand how they can be developing a housing market model without linking it to credit and credit availability and the credit impulse. As you know, I've been arguing for some time that it is the credit impulse which is fundamentally driving the way the markets work, and indeed my own modelling on home prices is determined largely by the rate of change of credit availability. Now, those of you who've been following DFA for some time will know that I've been saying consistently that as credit availability tightens, as credit momentum eases, as the credit impulse slows, we will see home prices dive. And strangely though, the RBA doesn't seem to think that credit should be in the equation at all. Now, I think I've got an explanation for this, and it's one I've made before, but let me just take it again. And that is this, that many people in the central banks around the world still believe that credit is unimportant because as credit grows, the assets and liabilities both grow, so they cancel each other out. So the net effect is zero. And of course, if you follow that line, then effectively you don't worry about growth in credit. You don't worry about the size of the debt burden because it is not important, providing that people can service those debts. But I'm very concerned about that, as you know, because I believe that it is credit fundamentally which is driving the dynamic of the market. And as I showed earlier on, the rate of change of credit availability is continuing to fall according to the latest ABS data. So I'm afraid that I don't give the RBA a pass on this particular piece of work at all. And I'm very disappointed that they've chosen to continue the illusion that credit is unimportant. What's also interesting, though, is that this particular model highlights the importance of interest rates and makes the point that if interest rates go up, that will have a depressive impact on home prices. Different, of course, from what Phil Lowe said the other day when he blamed house price movements on supply and demand. Firstly, a rise in migration, putting demand up, and then a supply of new properties coming on stream, putting prices down. I'm afraid that neither the interest rate argument nor indeed the supply-demand side of the housing discussion really explains what's going on. And the core thing to understand is it's all about credit availability and the credit impulse. Finally, a quick reminder, next Tuesday, the 19th of March, we'll be running our live stream event at 8 p.m. Sydney time. You're welcome to join us on the live stream and in the live chat to ask me questions, or you can send me questions beforehand via the DFA blog. Links to that blog are in the comments below. I hope you can join us next week. I've already got quite a few questions, but there's still space for a few more. If you found this useful and informative, please share the post, like the post, and add a comment or question. I read them all. And if you haven't yet subscribed, please do so to receive alerts for future posts. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you next time.